evening, everyone. Thank you for being here. We appreciate you coming and attending this. For all of our events, we offer them for our clients for educational purposes. We also always will encourage a guest or two. Feel free to bring them and introduce them to our wonderful team. To all of our clients, it's never fun to have years like this. I wish all the years just went straight up. But unfortunately, we haven't figured out how to make that happen yet. We keep trying, or we keep praying. I don't know what we're doing, but well, at least we're here when they do happen. And so that's a little bit of what we're going to talk about today. And as you can see, the title of the presentation is From Tailwinds to Headwinds. This probably isn't a surprise for most folks. You know, in 6 months, a lot has changed. Even at the beginning of the year, we were starting to get a little bit worried about things, but not to the level since then. And if you came to the last event that we had, John was the speaker and presenter on recessions. And lo and behold, we had some news last week that we just might be in a recession. So I'm going to talk a little bit about that today as well. The tailwinds that were present and kind of pushing our economy have certainly shifted. And so we're going to look at what's happened. We're going to talk a little bit about where we are now. We're going to talk a little bit about what's ahead for the second half of the year. As usual, I'm going to give you a couple pop culture quizzes here. We'll see who can get it right. So the first one here, it doesn't taste like chicken. Right? According to a popular organic market, in 2022, everything from soda to yogurt will be available in this trendy new flavor. What is it? Basil, cinnamon, hibiscus, or rose harissa? It says, if you can't read that, it says it's not just for tea anymore. So very popular ingredient now in a lot of stuff. So don't be surprised to see more and more of that as part of the trends go in our society. The next quiz, what are they looking for in a partner? So this is a fun one about dating. It says the 10th most popular dating app reported that 91% of singles would prefer to date someone who knows where to find the best price of gasoline, goes to therapy, has a similar sense of humor, or would prioritize the search for loved ones during a zombie apocalypse. That one was surprising to me, but 91% would prefer to date someone who goes to therapy. 88% are more likely to go on a second date if their date mentions therapy on the first date, but only 8% are willing to mention therapy on the first date. All right, what's this? Oh, wow. I didn't know what this was until this past weekend. And then I was looked at with astonishment that I didn't know what this was. So for those who don't know what it is a Wordle score, which is a new online game that you play on your phone. It's becoming increasingly popular, and those are now turned into a new art form using your Wordle scores to paint online pictures. So I thought that was interesting. And then the last one here, it's the next big thing for residential homes. So this is a new trend in interior design this year. It's been written up country living, house beautiful, and soon we'll have a streaming show, probably on HGTV. What is the trend? Is it Cloffice, which is closet offices? Is it mall revival, everything pinkish? Cinderella, which is glass blocks and clear furniture? Or is it Barkitecture, pet buildings and pet rooms? Ooh, that one's got you. Barkitecture. So I personally can tell you that we like to say that you don't make all decisions just based on the finances in life, right? So if you've ever heard me say this before, now I have a 95-pound Labrador, so I'm saying this because I am a pet owner, but financially, pets are already really expensive, but now we have to build them their own wing on the house. This is getting really expensive. We have to update some financial plans. All right, so I hope everybody's brains warmed up. Let's take a look and see what we've got uncovered in the economy so far this year. So not a surprise here, but fiscal stimulus and monetary policy were both very, very supportive of economic growth, essentially for the last couple years. And so going into 2022, Congress and the Fed, money supply was up 40%, and Congress had spent $5.7 trillion, which is a big number, right? So we think about that, and that is, I wanted to give you a breakdown of that because I know some people love those numbers. So Trump and Biden together spent that money. The money went to individuals and households, $1.8 trillion. Businesses, $1.7 trillion. Airlines, $80 billion. Healthcare, about $500 billion. State and local governments, $745 billion. So that's roughly the breakdown of the $5.7 trillion, so if you want to know where it went. So, and again, a lot of that was in the COVID stimulus. But just to give you an idea of what that's happened to. And then, of course, the Fed reduced rates to zero. And they also did the process that's called quantitative easing when they are buying bonds. So the Treasury is issuing them and the Federal Reserve is buying them, and that creates bigger money supply out in the system, and so that's what happened as well too. Some other things that now we can talk about a little differently the second half of this presentation, but going into this, the COVID cases had slowed pretty drastically, and also there was geopolitical stability, if you can imagine that now. So just 6-7 months ago. And I think the China and the US trade tensions were obviously not what they are today. If you didn't know, Pelosi did land and they didn't shoot her down. So I know that was a hot news item last night. So I just mentioned that because if you didn't pay attention to the news, that was a hot topic this weekend, and we actually went forward with it. But also, at the beginning of this year, Russia had not invaded Ukraine yet. Most people thought it was positioning, including me and a lot of the people that I had heard. I thought it was a positioning, and I didn't think that it would actually be what it is today. And unfortunately, it is still going on, which is pretty terrible, which is also going to be a cause of some of the things I'll talk about in a moment. The real economic growth in the U.S. So when we think about that, the economy grew by 6.3%. After inflation in 21. That's a big number. Of course, we're coming out after 2020 where we had a pretty steep and quick recession. So again, some of those numbers, 6.3 is from the previous year. Right? I always like to make sure we're thinking that way. If you have a 50% cut in your salary, the next year you get a 10% raise, that doesn't necessarily make you feel happy. And I just want to make sure it's relative. Just like if you had a 50% increase in your salary this year, and next year you only got a 3%, you probably wouldn't be quite as upset as if you didn't have the 50% before. So again, just thinking it relative, a lot of the numbers that we see, including inflation numbers, which I'll talk about, are in that way. So, and then of course we have Purchasing Managers Index was over 50, and that is a positive sign. Meaning that there's a lot of things going on in the industrial space and manufacturing space, and also in general in the overall economic business side of things. Jobs growth was strong. Now we can maybe have peaked as low as 3.6 unemployment, which is very, very low. I think we're back to 3.8, which I'll look at in a second. Labor force participation was up. So that was something that it was a positive because of COVID. We had vast lack of participation in the labor force. Or I think we bottomed out at 61% of people working age were working, which was, I think, the lowest since the Great Depression or something crazy statistically like that. So we had a very low participation rate, and that's increasing, which is a good thing. And then I guess we were buying dog furniture. So consumer spending was on the rise. I joked about it. We went to a farmer's market on Saturday and bought lemonades for my daughter and my niece and nephew. And the lady turned the little machine around that I stuck my card in and said, only a couple more buttons to push. And so it was a 25% or a 30% tip at the farmer's market for lemonade. I thought, wow, that is inflation. We did give her a tip. And then I thought about it afterwards. I don't know why I did it, because it was just her lemonade. But anyway, she should have just raised her prices. All right, so components of gross domestic product. So when we talk about the economy growing, we look at GDP mostly. And GDP in the first quarter, is what I'm showing here, is broken into 4 areas. So the 4 areas are consumer spending, which is the biggest component. So weighting them, this is 65% to 70% of what the number consists of. You have government spending, business investment, and net exports. And so what happened in the first quarter was we had this great trend of growth last year, and then all of a sudden we hear that we had a negative GDP. And then people started worrying, are we going into a recession? Well, what this is the government was pulling back on their spending, which causes a negative GDP because those dollars aren't going into the system. Consumers were still very healthy, good job rates, good job participation, and wages were going up, so we saw that. Business investment was still good at that time, and businesses were still spending a lot of money as well too and investing in things. And what hurt us though was net exports. And the reason that that happened is because net exports is our dollars going out to import goods, right? So net exports being negative is simply saying we imported a lot, right? So what did we import stuff for? Well, it's because our economy was very strong and the rest of the world hadn't kept up yet. And so because of the rest of the world was still suffering from COVID-related stuff and was not catching up to our speed, everything was cheaper overseas. So we started buying everything we could over there, and it made our economy, simply said, all of our money was leaving, right? It was going to other countries. So that caused a drag on our GDP, and so that's why you heard after the first quarter, it's not really a recession indicator. It's because our consumers and businesses are so healthy that we're driving down our net exports number. And so it wasn't a number to be concerned about, so I don't expect anybody to remember a day in the market, but the market actually had a positive day the day that we had negative GDP. Not surprising that the market did something that we didn't expect, right? But I did want to kind of talk about that because we're going to look at it again for second quarter that just came out. Story straightforward. The Omicron wave, the war in Ukraine, and new lockdowns in China took a greater toll on growth abroad than it did at home. And so that's what we started to see in that first quarter, and then tailwinds became headwinds. So we went from geopolitical stability to certainly instability. China, COVID cases on the rise. They have a zero tolerance policy, and that has a lot of impact on the rest of the world, including our economy. We stopped our fiscal stimulus and started raising rates, and basically quantitative easing stopped as well too. So we quit buying our bonds. So monetary and fiscal policy both stopped. China started locking down their economy, and Russia went into Ukraine, which causes a lot of different issues and is still causing some issues, which I'll talk about. This year, the U.S. is expected to grow faster than China for the first time since 1976. 1976. Kind of amazing, right? So I thought that was a pretty interesting statistic. This is a fun one that I found. Inflation getting higher makes it hard on the buyer. Unemployment on the rise. Gasoline engines filled with flies. Rent being paid late. Interest rates go up. Seems like no value in the buck. Meat prices up to stay. Utilities are on their way. Phone bills are in a race. Airlines are running late. 1975 by Billy Paul. Let the dollar circulate. So I thought that was funny. You would certainly have thought that that was this year, right? Things do repeat themselves sometimes. Huh? So let's look at the inflation numbers. So this is this year through the end of the second quarter, which is most of my data. An increase in the average price of goods and services, function of supply and demand as well as money supply, and PCE is a broader index than CPI. And so talking about this, these are the two numbers that we see often. So headline inflation is going to be higher than these numbers. But these two are the ones that the government really uses, the Fed really uses, and you can see the PCE price index is this column, and if you take out energy and food, you see that column. Now, I want to ask, show of hands, because the Federal Reserve raises interest rates to help fight inflation, okay? So when you think about what they're doing, when they raise rates, are you going to eat less food? Right? So I think about this also. You might drive a little less, but generally speaking, they're not going to rise in prices of gasoline, get passed on. They don't usually change behavior as much as they change the dollar amount. So the reason that we cut out energy and food is because the Fed doesn't try to fight those prices. The Fed tries to fight overall inflation, and if they were trying to fight energy inflation, and because it's more of a supply and demand issue, same with food, they'd be raising and lowering interest rates all the time in drastic fashion. Right? So they do not try to look at those two elements because those are irrelevant to what the Fed's trying to do. Now, what is the Fed trying to do? They're trying to slow down the price of houses and the house purchasing. They're trying to slow down automobile purchases. They are trying to slow down the economy. So I don't want anybody to think that there's anything that they don't know that they're doing. I mean, they are really trying to slow growth. And what did they do? January, all the way down, they have lowered it. Last month, June was 4.8. It was the first uptick really since February. I'd say now what the Fed's doing is they are raising rates aggressively, trying to get these numbers to go down, and this one, if you take out food and energy, is exactly what they're doing. Now, there's also consensus that it takes a while to see the impacts of interest rates, generally 4 to 6 months. And so if that's the case, then what you're seeing here is that we're starting to feel the impacts in these latter months of the very first raises of the year. So we should continue to see that. That's going to be a big topic, and it's something we're going to be watching for the second half of the year is where is inflation going. But from what I'm seeing, it is already starting to work. However, consumers are feeling pessimistic. And so this is an interesting dilemma, because if you don't feel optimistic, you probably won't spend as much money. If you don't spend as much money, then the store doesn't make as much money. If the store doesn't make as much money, then they don't buy as much stuff from other companies that make their widgets or whatever. And they don't hire as many people. And there the cycle goes again. Right? So then the consumers feel bad because they just got laid off. And so full cycle here, and again, it can also work the other way, but when we are feeling pessimistic, that's typically a bad sign for what consumers might be doing in the future. And so I wanted to make sure that you know that this measure of consumer sentiment has been going down. I think this is going to be the reason. So the four colors, 19, 20, 21, and 22, the years. This is April every year. And this yellow one is cost of living inflation. So it was one of the lowest factors until this year. So I think you would say, or pessimism is coming from this perception of inflation. And so it's pretty obvious when it comes to this. In 2019, the highest factor was healthcare costs. It's the second lowest year this year. Healthcare costs were number one concern, but inflation was not in 19, 4 years ago. So that's an interesting one, right? We're worried about our healthcare costs, but we're not worried about inflation. So healthcare costs have a higher inflation rate than the economy has had for the last 40, 50 years. Same thing with college education. College tuition has gone up at a faster rate than normal inflation. Healthcare costs have gone up at above average inflation. It's very interesting though that this is the problem. And I'll say something that it's a bit sad. Well, it's not a bit sad. It's sad to say 40-something%, very, very close to 40% of our American working population spend 100% of their income on necessities, right? They spend 100% without any discretionary income. So that means that when we have inflation, they still spend 100%. So that 40% does not change the GDP number. So now follow me on the math here a little bit. Those consumers are spending 100%. When inflation goes up, they're still spending 100%. Another way of saying that is only discretionary income changes the consumer number for our GDP. It's what we do with our discretionary dollars, and so therefore you would even argue that pessimism with people that have discretionary income is scarier, right? And so of course the news is going to tell you how bad inflation is on the working class, is the term that they like to use. I think that there's a lot of people working that aren't included in that class that they're talking about, but the idea with that is that those people have to shift their spending. They're still spending it all. They just have to spend it in different ways. And so it's a weird statistical thing, but just to get you to think about that, it is the discretionary spending in the country that really drives the change in our consumer side of our GDP. Let's look at how the way inflation may affect the way people think and spend. So this is a pretty interesting one. This was from the Washington Post, and George Mason University did this with their School of Policy and Government research. 87% of those surveyed were making a bigger effort to find the cheapest products when thinking about inflation. 74% were delaying their planned purchases. 59% were saving less. 59% were driving less. And then the most interesting one to me is 52% said they were going to go out and buy products now in anticipation of increases in prices. So when you think about what that means, is that we're starting to see the psychology kick in here. If you are buying in anticipation of costs going up, then when the company is raising rates, you're supporting them raising costs because you keep buying. And so that's where the psychology comes in. And I heard this from business owners: if you're not raising your prices right now, you're an idiot. So everybody expects you to raise your prices right now. That's not what we want to hear as consumers. That's a weird dynamic, but it's true. If everybody expects you to raise prices on your goods and services, you might as well do it while everybody's expecting it. You don't want to do it when they're not expecting it. Situation has been termed inflationary psychology. Consumers purposely advance their purchases in order to beat anticipated future price increases. Firms readily pass along higher costs to these consumers, including the future cost increases that they anticipate. Expected inflation becomes a self-fulfilling prophecy. And so this is essentially what we worry about when it comes to inflation at this point in time, is that we're seeing inflation because we're worried about inflation. So how do we fight inflation? Well, the Fed raises rates. So what's the Fed done? So this was at the end of the year, we were at 0. In March, they had their first rate increase, which is 25 basis points. In May, they had 50, and then in June and July, they had 75 basis points. So they've gone from basically 0 to 2.25. So they've raised them 2.25% in 7 months. They expect to get to 3.25, 3.5 by the end of the year, which means we have about 1% to go in interest rates. They have stopped buying bonds, which is the quantitative easing. They have begun to shrink their balance sheet, which means they're actually selling their assets. And then finally, they raised this federal funds rate. I did put that last chart down there because I hear it so often. That's 1980 and 81. That year, they went from 14 to 20%, which was a 6% increase in that single year. So when we think about going up 2.25 or even 3.25, it's not anywhere near what that 1 year was in 1980. And of course, where were we starting from there versus where we're starting from today at 0? It's a very different landscape. I'll put that in your brain and we'll talk about it a little bit more in a second. So where are we then? So this is kind of the struggle, is to see which path will we take as a country, maybe as a global economy, but I think we would all love to have this soft landing, and I'll talk about that in a second. Stagflation and recession, all of these I'll touch base on, but the soft landing is essentially that the economy slows down. The Fed's trying to get it to do that, right? If you know someone looking for a house, it's really easy for them to say, man, I'm really hoping these prices go back down. But if you're trying to sell your house, you want the highest price you can get. And so we've had a nice run around here, we all know, and all justify that. We live in wonderful Wilmington, so we're going to have a better chance of keeping our house prices higher. But I certainly remember 2005 to 2012. We didn't keep our prices then. We sure have a lot more people here than we did then. And so the ebbs and flows of the real estate market a lot have to do with that interest rate change. So what's going to happen here in a soft landing is that the economy slows, inflation begins to drift down, and we avoid a recession. So that's the definition of a soft landing. Earlier this year, I was much more convinced that that's what we were going to see. I'm less convinced that that's what we're going to see going forward, but I do not rule that out. I am not against what the Fed is doing at all, but they are just one part of what makes our economy move. And so soft landing is still very possible, and we'll talk about some of the reasons why, but one would be hopefully inflation drops quickly, supply opens back up, and the job market doesn't change. Those would be three things that could really help the economy have a nice soft landing. But then we have this other idea of stagflation. Stagflation, we'll probably hear more of this in the news if inflation stays up, because inflation persisting with slow economy is what stagflation is. So it's basically prices are going up, but growth is going down. And so we can't afford as much, but prices are staying high. Everybody loses in that, typically. So that's a bad scenario. We don't want stagflation. I'm not saying that we are going to have stagflation. I think of the three, this is probably the least likely, but it still has some possibility out there. We haven't seen it in a long time. You know what we have seen? Deflation. We've seen more deflation in my career than we've seen inflation, which people don't fear that as much, but deflation is what happened in COVID. It's what happened in 07, 08. It's what happened in 2000, 01, 02. Deflation is actually worse for us than inflation. We want to have inflation. We just don't want to have too much. And then finally, recession. And I think coming to John's presentation or even mine at the beginning of the year, what we talked about, and I've probably mentioned it to clients as well too, recession could be the easiest fix to this economy. That's a terrible thing to say, but it's a quick fix, meaning that we can hurt the economy, then all of a sudden supply will open back up because people will stop buying stuff. We won't have the supply bottleneck. It'll drop inflation because companies will start trying to sell stuff because there's less buyers, and then all of a sudden we have a much quicker recovery to get back to normal. Now, I don't want that to be a deep, painful recession, but a mild recession wouldn't probably be too bad, and we might already be close to that. So we'll talk about that in a second. I would mention that the idea of recession, which John spoke about in his talk last time, was those are normal. And normal recession is expected, I don't know, every 3 to 5 year business cycle we would expect one of those. Let's go ahead and get ours and get inflation back down. That'd be nice. So is the economy in a recession? No. People are unhappy with inflation, which has recently been running its highest since 1982. But inflation isn't recession, which is defined as a significant decline in economic activity. Economic activity is not falling. Quite the contrary, it's booming. So this was Harvard University's professor of capital formation in June of this year. So that's an interesting perspective, as I just talked about the three outcomes. And we heard, well, maybe that first quarter number was a little funky because it was strong consumer and strong businesses were actually causing our GDP to go down. Well, now we had, last week, Q2. So now let's take a look at that same chart. So what we have here is we still have a strong consumer. The consumer is still a positive contributor. Thank you all for shopping. Government is cutting their spending less. They are spending a little bit more or cutting their spending less is really what they're doing. Business investment is where we got hit this time around. So the second quarter, businesses said, whoa, I'm not buying anything right now with these prices. So a lot of B2B, meaning business to business, a lot of investment, a lot of purchases and contracts and things like that slowed down, and this became the drag on our GDP number, and net exports actually flipped for us. So we did change, but really what we saw here, these two numbers have flip-flopped. It's a little less rosy picture because of that number. in my opinion. So do we have a surplus? Are we okay? Can these companies get through? Well, we'll have to wait and see. But it's a little bit about where we've been up till literally last week. It's this data here. I would remind you that the economy is always in a cyclical nature and always going through these different parts of the cycle, right? And so when did we peak? Well, I would say the peak's over. So the question is, how deep is the recession going to be? When's it going to be? And then when do we bottom out? And then when do we start moving again? And so the thing about the economic cycle that we talk about here is, unfortunately, it's the same old scenario of greed and fear. And so what happens is we have this massive liquidity, and we see excess in some area of the economy typically. Sometimes it's broad-based. And then as that excess gets too much, it breaks. And then all of a sudden we have to work the excess out of the system, which is the recession. And then at some point we've bottomed out, we've got that out, and we can start moving again in the right direction. And so we'll talk a little bit more about that in a second, but I just to give you the nature of that cyclical behavior of our economy. All of that's new, and we're going to talk a little bit about what might be excess. One could have been the financial markets. And I don't know if anybody could see that, but that's a bear. And the bear is, of course, at the therapist. Probably make a good date for somebody. And it says, why can't they call it a deer or a squirrel market? Bears are interesting because bear markets don't, a lot of people who are called bears are basically looking at things from a risk perspective. And we certainly do that as well. I am one of these people that you could say I'm realistic in the here and now. I am optimistic in the long run. Right? So I rarely get too pessimistic because I focus on the long term anyway. By nature, that's what we do in investments. And most of our bear markets have been temporary, but I love the idea here. But we all heard this news. This drove me crazy. Why? Because that's what it was. It's the worst first half for stocks in 50 years. It was by far not the worst year. It was just the worst first half. But we got to say that, right? And the media got to say that, and you got to turn on the TV, and you got to start worrying. So you turned it on the next time, and they got to sell ads, right? And the cycle continues. But realistically, this was a very bad start. So this was a bad beginning. And if you go back to like 08 was a very bad year. But it all happened in the second half of the year. And it was much worse than this. Same thing with 01, it's 9/11, 02. So some of these were in there as well too. But it was a very rough start. How rough? Well, there we go. So let's take a look at it. So I'll go through the top numbers of S&P. Year-to-date return was negative 20% at the end of the second quarter. So this is June 30th numbers. And the second quarter was 16.1% of that 20%. So the second quarter was really rough. In particular, I think you probably have paid attention to news. There's been a little reprieve from that since then, but June was really bad. This is the all-cap world index. The world index was down just about what the S&P 500 was down for the year. And then I'll move down to some other areas. The bond market was down 10. I'm going to talk more about the bond market, but typically when you hear the stock market down 20, you don't hear the bond market down also. Now, ironically, the 20% S&P is not nearly as bad as COVID. It wasn't as bad as 07, 08. It wasn't as bad as 01, 02. So that 20% was actually the same drop that we had in 2018. Not a year that any of you remember as being particularly scared about the stock market. Right? So it's interesting that the 20% in the stock market isn't quite as bad, but coupled with a bad bond market, all of a sudden diversified portfolios look pretty lousy, right? And the reason, and we'll talk more about the bond market, but that's when we think about a portfolio, if you've got typical 60% stock, 40% bonds, 60% drops, and the 40% stays stable. Well, in this situation, we had sort of both sides of the balance sheet. dropped. The equity side and the debt side both dropped, and so it became a little more painful this year when you open your statement. But it was by far not as bad as some of the past that many of you have experienced, even as clients of ours as well. The aggregate bond index being down 10. Down here, the corporate bonds, which excludes any government-related stuff, was down 15. So that's another area of the bond market. So you're talking about 15% drop. Now, interesting, there is one positive in here, which is the energy sector, up 30% through June 30th. Anybody surprised? Did you fill up your gas tank? So 33.8 was communication services, and large growth was down 39.3. Large growth are some of the biggest technology companies that you can think of. Apple, Microsoft, Amazon, Google, other companies, Tesla. So these big growth companies were actually the area that has hurt the stock market the most this year. Now, they also were the best performing asset class over the last 10 years. So do you abandon that because that has its one bad year out of 10? And I think that's something to just think about. It's really about diversifying our portfolios anyway, but I would just say that this, when you think about the area that got hurt, that's the same area that everybody wanted a year and a half ago. You can't lose, right? COVID came. We need to invest in all the technology stuff and innovation. We don't need the old stuff. We need the future. Well, the future got us this year. Took us down 40% through the end of the second quarter. And then I just mentioned this, the Russell 1000 value versus the Russell 1000 growth. So this is showing the difference between growth and value right here. And there was a 15% difference between growth stocks and value stocks this year. So if you were concentrated on the value side, you didn't have nearly as bad a year as you did if you were concentrated on the growth side. And I think that's where people will compare differences and see that often. So this is, part of this is not only that you see the numbers, and we all know that the stock market was down, but why does it affect us as much? And it's volatility, right? We don't necessarily love the ups and downs. We love the ups, but we don't like the downs. And so when we look at this, it says this is the first, this was every year through up or down days through June by calendar year, all the way from 1998. Since 1998 is what that's saying. And this was the third highest year since 1998 in days above 1% or below 1%. The other ones are COVID and then 09, the recession, Great Recession. So this year there were 63 moves of 1%, 26 moves of 2%, 7 moves of 3%. And we actually had one more day of 3% moves since this data came out. It was a positive one though, so that didn't feel quite the same. So again, it's a very volatile year. It's probably why we had so many people want to come. So, or because inflation's high and you knew there'd be free beer. This is sectors. So again, just kind of thinking this through, the bottom two, consumer discretionary and communication services. Communication services are things which you would expect, like AT&T and Verizon, but communication services also includes things like Facebook and social media and things like that fall in it as they change that. You might think that was an information technology, but that's not the way it is anymore. And consumer discretionary holds Amazon. So they pulled those tech stocks out and put them in different sectors to more closely align them with what they do. But then you look at it across the board, and you did have 4 sectors that were up. Healthcare was barely up. Consumer staples, utilities were up 10%, and then energy up 36%. So there were some shining spots out there, but it's also a little bit obvious, right? Because these are areas, the energy is where we saw the inflation, so we would expect that. What we buy in portfolios is stocks. When we think about those stocks, we think about these companies that are trying to generate earnings, those earnings turn into value for us, the shareholders. And as we look, this is the expectation of where we will be with earnings in 22. So we expected low earnings this go round, and then we expect a rebound in the next 2 quarters. This could certainly get revised down quickly. I would mention that the second quarter is underway, and if you read our Monday report that we sent out on email, over half of the S&P companies have already reported earnings, and 75% of those have beat expectations. So we're seeing earnings actually exceed expectations, but relative, we had pretty low expectations, right? I feel like if I bring my wife flowers, I'm always going to win because she doesn't expect that as often as she should. So I keep the expectations just right. This number at the bottom here is 10.2%. So 10.2% is not a bad earnings growth rate. I don't know if it will really hold, and in 6 months from now if we'll be seeing the same numbers, but I would tell you right now the estimates are still pretty healthy for the economy. Now there's a lot of things that are going to be weighing on that, and we'll talk about those. I would mention though, what about pricing? So if earnings are going to be good, what about the prices of stocks? And the prices of stocks, we measure that over their earnings and get this number called the PE ratio, which I talk about almost every one of these. How much are we paying? What's the price we're paying for the earnings PE? So when we look at this, the historical average is about 16. And that's a very long average, probably not the best one to use because it goes back to like the 1800s. But if we look at where we were a year ago, we were at about 26.5. And at the end of this quarter, we were at 19. So stocks have dropped down in their PE ratios, meaning there's more value in buying stocks now than there was in June of 21. Well, hindsight's perfect. Yeah, that was really easy to see now because the market's down, right? But from June until January, we had a really nice run. And so again, I don't want to make this correlated exactly with the market movements, but what I would say is that overall, with the earnings growth and the stock prices dropping, stocks have become more attractive than they were even 6 months ago. There is one that we also watch, Shiller-CAPE ratio, and this is the cyclically adjusted PE ratio. That's what CAPE means. And what that means is that he takes a 10-year averaging and sees where we are over 10 years adjusted. And this one still says we're pretty expensive. Far less than we were over the last couple years, but still pretty expensive. And so it is a number that we watch. So I would not tell you that stocks are cheap. I would tell you they're much more relative in their valuation than they were 6 months ago, a year ago, and it feels a little bit more normal to buy those than it did 6 months ago, when we had said, prices have gone up a lot faster than we thought the economy had gone. I love this. Stock market downturn suggests that many investors expect a recession. And they might be right, but they could be wrong. So back in 1966, following 2 decades of nearly uninterrupted economic growth and stock market gains, a bear market arrived. The S&P index dropped 24% over 8 months before a bull market began. The market downturn was unnerving, but there was no recession then. That year, Paul Samuelson, the economist that I'm quoting here, was the first person to win a Nobel Prize in economics, if you didn't know who he was. And he made this comment: the stock market has predicted 9 out of the last 5 recessions, right? So I just think that's funny. But actually, he turns out he was right. So since the World War II, there have been 13 bear markets and 7 recessions. So it is right. It's about 53% of the time. So I thought that was pretty funny. But basically the idea here is that just because we have a bear market does not mean we're going to have a recession. But 53% of the time, it could mean we do. Unfortunately, we are in a bear market for bonds. Bonds are what I mentioned, I talk a little bit about. Bonds are typically the safe haven of a portfolio. We say that when the stock market's down, we'll sell from your bonds, and that's how we'll provide the liquidity that you need so that you can keep on living the lifestyle that you want. When a year where bonds go down 10%, that doesn't feel quite like the best strategy. Now, what do? We front run, and we keep a lot of money, typically a year ahead in cash of the needs of our clients. And then we have some very short-term, high-quality bonds in there that serve as the next cushion so that they don't see the 10% drop. And so we build that around people's needs for their cash flow so that we don't have to sell even bonds in bad markets that are going to be fluctuating a lot. This is the 10-year and what's happened with interest rates, and this is since 1960. So as you would guess, this period of time is the 80s, right? So interest rates, now we all think of it, most people that remember the 80s don't tell me about how their 20-year treasury bond was doing. They tell me about their mortgage, right? It wasn't that most of our clients weren't sitting in 1980 going, yes, I get to buy some CDs at 16%. No, they were going, oh no, I've got a 15 or 20% mortgage. And so, but now we're in a different situation here, particularly this group. We aren't worried as much about mortgages as we are about what we're doing with our earnings. And so this is actually detrimental to us to see it so low. So maybe, just maybe, we like these interest rates going back up. And I would argue that it's a really good sign for investors who want to have some safe money, which most of us do in retirement, which is that now we are getting paid twice what we were getting paid at the beginning of the year. John and I met with Fidelity yesterday, one of their total bond managers. He manages about $35 billion in bonds, and he said, we have seen an increase in taking on risk and it's paying off. And what we should see is rates continue to go up, and then if and when, and they think that we will see the top of the inflation, and therefore rates will eventually slow down here, maybe even cut them sometime next year, but that we will be able to benefit from this short-term spike in rates. And instead of what he would have told you at the beginning of the year is we'll be lucky if we make 2.5%, 3%, now he's saying we should make 4.5%, 5% on our bonds going forward. So almost doubling the return, which is, it's painful because how we got here to start that journey, but it is nice to think that way. Bond market does indicate inflation often, which is a bit strange. So we look for that to tell us whether we're going to have inflation, and that's what we're going to see. This year, bonds went down quick, and interest rates had only moved 25 basis points. So the bond market priced in a year's worth of interest rate increases in the first 3 months of the year. So we're actually seeing a recovery in bonds over the last month, pretty aggressively, which is kind of nice because now we're worried about recession, so people aren't feeling that they're going to be able to keep raising rates as much as they said they were. Does that feel good yet? Because we might have a higher chance of a recession, our bonds are recovering, and the stock market did really well. Kind of crazy. Another one we've talked about is yield curve. Yield curve, I'll kind of skip that one. I know John talked about that too. When it inverts, there's some signals that we might be in a recession. We actually didn't have those indications. We have this U.S. Treasury curve, which is what I'm talking about. And so this shows that there's a gradual increase. We look for the 3-month and the 10-year. We look at the 2-year and the 10-year. We look at some different ways to see whether or not we're inverted. And there was one of those inverted, but not all of them. And so we never got a full inverted yield curve for the year, but we came very close. So that's another indicator that could be telling us we're going into recession. Probably what's, again, back to that consumer sentiment, we're watching the bullish indicator, which is how many people are feeling good about investing, and if, as you would guess, it's gone down. And so, until last week probably, and everybody was feeling good again. But I would just remind you that bear markets don't last forever. We have them. We have plans for them. We expect to have them often, but I like this chart because it shows the depth of what we have seen in the past. So 1973 was the oil embargo. We had 126% recovery. We dropped 27% in 1980, and we had a 229% increase until 87. 87, remembers that one, 34% drop, had a 65% recovery. 90 was a negative 10% drop. There's that big bull market in the 90s. From 1991 basically to 2000, Y2K, 9/11, Enron, almost a 50% drop. We recovered 07-08, the Great Recession. From the Great Recession essentially until COVID, we had one heck of a run. 18, we almost got to 20%. We only got to 19.8, so they didn't consider it a bear market. But these two are big bull runs. And so we're down 27%. Is it the bottom? Have we moved past it? I don't know. I will say that typically in a recession, the bear markets will drop 35% or so. So we would say we didn't quite get to the bottom yet if we see a big recession. So let me go through these. So I'll go through these kind of quickly. Global economic growth after inflation. So these are projections. And you can see Russia's not looking too good. Emerging Europe is not looking too good. These are not surprises. Most of those are Ukraine and Russia related. But this 2023 is the yellow that I would highlight. And we're seeing pretty positive growth across the board, even as we think there might be some recessions in there. And so overall economic growth is still expected to be positive, just not very positive. So I would tell you that we would expect to see some recessions. Certainly Europe is at risk of having a deeper one because of what I'm showing here. So war in Ukraine, it affected food and oil drastically. This isn't probably surprising news to anybody, but looking at this, global food export, how much comes from Ukraine and Russia? Sunflower oil, 64% of the world's sunflower oil comes out of those two countries. Yellow being Ukraine, red being Russia. So you look at wheat. Wheat is 23% of the world's wheat comes out of those two. Barley, 19%, and maize, 18%. So pretty significant to the food source. Obviously, we use that to feed our livestock as well, too. So that affects other things. So that's why that became inflationary and why we had that second bout of it. Spillovers from Russia, invasion of Ukraine are set to sharply hasten the deceleration of global economic activity. The war in Ukraine is leading to high commodity prices, adding to supply disruptions, increasing food insecurity and poverty, exasperating inflation, contributing to tighter financial conditions, magnifying financial vulnerability, and heightening policy uncertainty. None of that is surprising. It's all very sad. And I would tell you that the day that that stops, the world's going to celebrate. So if something were to happen and those conditions were to change in a positive way, meaning essentially something terrible happened to Putin, and that's an opinion. I hope you agree. I hope you agree. But that in itself, I would tell you would be a very positive catalyst for people's thought process globally, and we would start to see things change, and I think pretty drastically. So we can't control that, but what we're going to see is if it drags on and on, you're going to see the changes in the way that we get our supplies. And so the way that the economy fixes bad stuff like this is either the flip-flop, supply-demand, major issues shift, or we slowly change where we get our supplies from. Right? I think one of the biggest fears that people have is that most of the semiconductors in the world are made in Taiwan. Why aren't we making as many semiconductors here? Well, we slowly will be. Of course, if something happens, then we'll be forced to do it faster. And that's part of the supply chain issue. And so it's just not that easy. COVID lockdowns are crazy in China. I don't know how much you've paid attention to it, but everybody's getting tested every 3 days in China. And it is hurting their economy badly. That's why we're outgrowing them, but that also, because we're so dependent globally on China, that is causing a lot of the pullback, recessionary pressure, and also inflationary pressure. Possibility of a Fed Reserve policy mistake. We could argue this all day long. Will they raise rates too much? We'll find out later. All right, that's the thing. It's tough to say, but I mean, we'll find out later. We can point fingers backwards. Fed raises rates too slowly, and inflation stays high. And so right now, they haven't proven that they're going to do that. I think this part will be interesting. They change the formula and they level it off. And so I'm very curious how they're going to handle this the second half of the year, and the markets will react to that. Right now, we're starting to see the differentiation between people thinking there's an increased probability of recession, so the Fed will stop raising rates. So you saw your growth stocks recover, and then we're seeing the bonds recover. Investor behavior. Probably one of the biggest issues for your portfolios will be how will investors handle all this news for the second half of the year as we work these things out and work the excesses that we had. I'm a little nervous about investor behavior. I'm just as nervous about last week going up really quickly. It doesn't hurt as bad when it goes up really quickly, but it's a bit strange because that was bad news that caused the market to go up. All right? And so we want to keep watching that. We want to stay well diversified. We want to keep with our high quality portfolio, but we do watch that because it is one of the factors that causes volatility. It doesn't necessarily cause long-term pain if you don't sell, but it does cause volatility, which makes people nervous. So what do we do in a bear market, and what should you do? Well, it's the same old thing that we always say. It's boring, right? We can sell, we can stay invested, or we can look for opportunities. So if you sell, this is what we hear. I'll cut my losses. I'll preserve what I have. I won't lose any more. So if these investors were to do that, they'd be willing to accept the loss of principal, and then they would not be able to recover that. So we're never going to tell you to sell because we have a portion of the portfolio. If you need to access it, it's not an all or nothing decision. Right? How much money do you need? Do you need 100% of your portfolio right now? Now, I would say, generally speaking, except for a few, I would say, more politically charged fears, investors have been very good at staying invested this year and staying the course. So I think that that's great. It's not bad behavior. I will say that's not the case for the people who made all the money right after COVID, and they ran into all these crazy stocks, these meme stocks and all this other stuff. Those people have been punished and they've lost 80-90%. So I'm sorry y'all missed out on the 75% on the way up, but you didn't lose 90% of it since then. So staying invested, always the strategy that we're going to tell you to do, unless you have some excess capital sitting around. And if you do, these are the opportunities. What's the old rule of thumb? Buy low, sell high, right? And so when they're low, we want to buy. And so I have a list of clients that I know always have some extra money, lucky for them. And I send them one, it seems like about every 3 or 4 years. I'm like, the market's down 20%. I don't know if it's going to be the bottom, but if you've got some extra money, it's probably time to put it into the market. And we don't get those opportunities often. So we had them this year, we had them in COVID, and then we had them in 18, and then before that it was 16. And so every 2 years, and then before that was 2009. So that was a long time. This is just saying don't get jittery without calling us. So work with a professional. Go through some of this, and he's got 4 more slides here. I'm going to read them to you. They're all different opinions, and I just wanted to kind of give you some of the figurehead talk that's out there. The first half of the year was terrible, worst in decades for stocks. Arguably, the biggest single cause of misery was the spike in oil prices. Russia's invasion of Ukraine accelerated a rise that was already building as the world emerged from the pandemic. To be sure, a lot of damage has already been done by high energy prices, but if they fall back soon, as history suggests they should, then the second half of 22 could be much better than most people currently expect. Now, we don't get to vote for which of these scenarios we like the most, but that one sounds pretty good. This is Seth Carpenter, who's a Morgan Stanley chief economist. It's very difficult to resist the temptation to draw parallels with the 70s. But consider the following. In 1970, anyone 40 or older had already seen 3 episodes of inflation comparable to that of the present day. Today's 40-year-olds have seen nothing comparable, and in fact are more familiar with deflationary trends than inflationary ones. In 1970, the thought must have been, here we go again. Whereas the question today is, what's next? So again, I think that's a good perspective on things. I mean, if you're a 65-year-old news commentator and you're talking about inflation, you probably don't know what you're talking about from a realistic perspective. It's kind of crazy. We can certainly hope for a soft landing this time, but in my 35 years in the business, hope is rarely an effective investment strategy. The backdrop is one of a peak in liquidity and economic cycle, and what follows is the natural expunging of the excesses. And in this case, meme stocks, cryptocurrencies, speculative, NASDAQ 100, even residential real estate, which is in a huge price bubble, and then the rebirth. So David Rosenberg is president of a research company. And again, I think we would all kind of feel that is right, and that's what I mentioned about the excesses and working them out. Actually, somebody in here made a joke to me recently about holding off on the cryptocurrency, which I got a big kick out of. And then I believe this is my last one. The most important, the opportunity for innovation remains vast. The potential market for technology products has expanded hugely beyond the bastions of business and consumer computing to affect all parts of the business world, from biotech to supply chain monitoring. What emerges from the chaos will be a leaner and more efficient industry, and one that will remain a powerful force. And there, my friends, is innovation and productivity which drive economies, which is fantastic. So I know I've kept you long. I have one closing slide, but I want to take questions before I do that. Anybody have any questions? I wear you out too much? Yes, sir.
I'm curious, given your portfolio views,
Yep.
what do you think the risk is to us financially if China were to create there is indeed a China bubble and they go into a deep recession or depression?
Yep. So the question was whether what would happen to portfolios if China went into a deep recession or depression. It is a significant risk, more so to the international portions of the portfolio. So for our portfolios, that's typically running 15 to 20%. Emerging markets direct exposure to China is less than 3 or 4%. So when I think about the drop in the portfolio from there, just direct exposure, the international markets, Europe is tied heavily to the Russia-Ukraine stuff that's going on right now. But they're also tied to China as well, more so than we are. So both of those parts of the portfolio would get hurt pretty drastically. The US would probably experience inflation that would be extended, which would be painful for us. And so my worry would be more about inflation because we'd have to find ways to shift things from manufacturing and goods and services and all that, and that's going to cause it. So it would pull down global GDP. And I think it would be similar to an impact that we would have on the rest of the world as well, because they're not quite to our level, but it would be, and I don't want to make a comparison to 07, 08 directly, but it would probably be resembling something more like that than temporary blip in the portfolio. It would be a long, drawn-out issue as we restructured. But again, I'm not saying that I'm not calling for that or anything like that. I'm saying if I was thinking about what the ramifications were of that, I don't know that, for example, there's a lot of positioning against, does this mean China-US war, right? And I don't think that's a possibility that I would invest your money towards. If we have enough bad scenarios, first, we wouldn't be serving you any alcohol. So second of all, we would not be investors if we took the gloom and doom approach all the time. So just being mindful of that, we are risk managers. And so the bond portfolio side would get us through, and we would hope that our bond portfolio liquidity would exist, and that would get us through the time that it would take to get through the bad market. So back to 07, 08 as an example, if you did nothing, and a lot of you in this room were clients of ours and were retired at that time, if you did nothing but stayed invested and let us draw down the parts of the portfolio that we needed to at that point, we got through, and you got more money today than you've ever had. And so that's what I would assume for that too. It would just be a painful duration, which is, COVID was not painful duration from our portfolios, but 07, 08 was. Other questions? All right, well, I got a closing slide. I'll let you go then. And for those who've been here before, you heard me say this in some sort of way, because I always close with the same thing. I wrote it this way. Oh, actually, I'm sorry. I read this statistic today, which was unbelievable. And this is sad, and this is setting up for a really weird tone. More Americans died in 2021 than in any year in U.S. history. That's a crazy statistic, right? So here's my last slide here. There is no free lunch. So we build high-quality, diversified portfolios so that you can meet your liquidity needs and live the best life that you can afford. Markets and economies don't determine your health, your happiness, your longevity, your social functions, your family relationships, or virtually anything that should really matter to you in life anyway. Markets and economies continue to do what they always do, while also remembering the media and our own minds do what they also always do and create the illusion of importance on things out of our control. As a famous rapper, like this one, Flava Flav once said, "Don't believe the hype." So, maybe, no, okay. Live your life with true wealth. Those are the things that money can't buy and death can't take away. And then, of course, I'll just say on behalf of the entire Pathfinder team, thank you for being clients. Thank you for entrusting us with your financial future. We feel it is an honor, and we really appreciate the opportunity to serve you. So with that said, thank you.